It's not a big yacht. It's not a Ferrari, although a Ferrari would be nice. Who doesn't want a Ferrari? So my summit is really just living my life the way I choose to do it, not the way somebody else tells me to go do it.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Yeah, so we met back at Raisefest last year. I think one of the biggest things that stood out to me from Raisefest was just that Hunter Thompson truly under-promises and over-delivers in everything he does. I think you see that in the meal and the food that he provides. It wasn't a lead magnet to get people there. In fact, he didn't even tell people until an email like 4 days ago.
Yeah, it's been pretty amazing. I've watched this grow, and I think I went to the inaugural one. I was pretty early, in Raise Masters, and it's been amazing, the growth, and he provides tons of value to the community. I've been made some friends, made some business contacts, and this is all around a productive event. So I really love being here, and good to reconnect with you as well.
Absolutely, yeah. It was definitely a pleasure seeing you, meeting you. You took the time to get to know me a little bit back then, about a year ago. I signed up for JCAM newsletter, and actually a lot of the work we're doing now is modeled off some of the things that we've seen within your newsletter. So, man, I guess you probably didn't even realize it was happening, but we've been looking to see what clues your success has led to. And
well, that's great to hear. Like, I've always had that abundance mentality, and I've always been somewhat of an evangelist for real estate. In my early 20s, I bought a 2-family house and was house hacking, and I was trying to get all my friends to get into real estate and house hack, and I got a lot of my friends into the business. After the financial crisis, I somehow pivoted myself into Wall Street. Wall Street needed real estate guys. Yeah, I'd been flipping houses, doing wholesale, do all the traditional until 2008, and all the hedge funds were buying these non-performing loans, and they needed real estate guys who'd been flipping houses and then done short sales to work on the banking side to make sure that the investors didn't rip their faces off and take advantage of them. So had a crazy 10-year run in Wall Street. We did deals with Goldman Sachs. We did deals with Fannie Mae and Freddie Mac. I met a character from The Big Short.
Really?
Yeah, the character, they changed his name in the movie, but his name's Greg Lippman. He runs a fund called Libermax, and they would buy our mortgage-backed securities. So we would buy loans, get them reperforming, and then re-securitize them.
That's awesome. So why did you leave that?
So the problem is it's a Wall Street grind.
Okay.
We merged with a larger private equity fund, and these are all guys that came up in Bear Stearns and Lehman Brothers, where you sit at your desk 80, 90 hours a week, and certainly not that passive income, that lifestyle business. I got into real estate because I read Rich Dad, Poor Dad, and I read
the little purple book.
Exactly. Yeah. So I read. I really wanted that flexible lifestyle, the ability to control my time, and in New York, that's just not part of the culture. Right. So I got pretty burned out and pretty disillusioned, and just was looking for a better way to improve my lifestyle.
Okay, that's interesting you say that. We call that reaching your summit, right? And it's like, I think when people first hear, they're like, what do you mean? You're just talking about backpacking and climbing mountains. But, it's interesting. I didn't think the conversation was going to go here, but since the door is open, I think everybody is chasing some sort of a summit, right? A lot of people think maybe it's a Ferrari and a big mansion, up in the hills overlooking the ocean. But when they get those things, they realize that's not what they actually wanted, right? They're chasing that feeling of, they're talking about it today, right? A feeling of fulfillment. And what does that really look like? We call that your summit. And it's really the core of the work that we do, is helping people see what that summit really looks like. But that's huge, man.
Yeah, that's great stuff. And I heard a quote recently, like, so many people have accomplished the goal that they thought was going to make them happy, and it doesn't really get you there often. Money also doesn't solve all problems. I fortunately had a multi-million-dollar exit. And certainly I'm a little more comfortable. Not always even less stressed though. There's still things that'll stress. It's not like I just retired and went on a beach. I started a new business. Raising capital, investing in various multifamily and commercial assets, and the last year or two has been a stressful time in that market. And I've been through multiple crashes and multiple cycles at this point. So I've seen it before, but each one's a little different. Howard Marks has a great book on market cycles.
Okay.
And he says repeatedly in the book, history may not repeat itself, but it does rhyme.
Right. To definitely go back and look at history and see how we can adjust fire, right? Look at those lessons learned and apply them forward instead of letting them happen to us. So you say you got a lot of stress right now. What's been causing stress over the last couple of years?
Well, the interest rate move over the last 2 years is really unprecedented. I mean, to go from practically zero to between 5 and 5.5.
Money.
I mean, if you look at it on a chart, it's parabolic.
Right.
And so, that's caused some stress, especially on deals that had variable rate interest rate debt. And we're pretty active in the multifamily market. And when you purchase multifamily, if you go in with long-term fixed rate debt, there's extensive prepayment penalties. So by design, a lot of partners actually almost had to use variable rate debt because the goal was to get in, you renovate a bunch of units, and you sell the building in 1 or 2 years. And if you had a 5-year debt, the penalty for selling in 2 years would eat up too much of your profits. So those deals were variable rate, and there was an ability to buy an interest rate cap. And so most of the time, the maximum a rate could go up would be 2% over a period of 2 or 3 years. Now rates went up 5%, and it's been 2 or 3 years, and they're still high. So now those interest rate caps are coming due, and it's very difficult to sell or refinance in today's market right now. So, what we're seeing is the quality operators are finding a way to make it work. Sometimes you have to put additional capital into a deal. Sometimes you need to restructure. But the people that were unprepared or undercapitalized or were kind of groups of newbies that went to a seminar and pulled their money together,
right,
they are really struggling. And, the groups that are sophisticated, that have some capital, have some dry powder, are navigating it through. And, I talk to a lot of people, a lot of real estate investors, or just people in general who they think back to 2008 and they think that the real estate market's going to crash. And I think what people need to realize is that, 2008 was probably a once in a lifetime crash because everything crashed at once.
Yep.
The stock market was down. The whole mortgage-backed securities, it almost brought down the economy. This time around, the residential side is very, very strong. And, multifamily is really a commercial asset, but it still has residential components to it. But the single family residential market is about as strong as it's been. There's not that much supply, and you have 70% of the population that's locked in. Either they don't have a mortgage.
Can you go into detail on that? Because I don't think a lot of people hear the news, the headlines, like interest rates are so high, and they think like, okay, everything's going to crash. They're getting, myself included, flashbacks to 2008, right? I bought my house in 2007 and overnight watched half my value vaporize, right? It was unsettling to think that I was going to have to pay somebody if the military made me move, right? I was going to have to pay somebody to take my house. But today it's different. We're not in the same conditions because of that locked in piece. And that's the piece that the newspapers aren't telling the country.
Yeah, absolutely. There's a couple things there. Number one, new construction has never caught back up since 2008. So there's not enough new houses built for the demand that's out there. In 2000, the mid 2000s, most people got into these option arm mortgages where
right,
there was a teaser low rate for a year or two, and then it jumped up. Now, 30-year fixed, when I was mentioning that 70%, 40% of the population doesn't have a mortgage. There's a lot of baby boomers that just have houses paid off. The other 30% are locked in below 4%. That refinance boom of the last 3 to 5 years, so many people locked in. I have 2.88% on my place.
Bro, yeah.
So they're kind of trapped in their house at this point.
They can't move.
Yeah, they can't. Or if they were, the logical downsizing, like say someone's an empty nester now and they've got a 4,000 square foot house, they had a couple kids, the kids are all out. They want to switch to a 2,000 square foot condo.
They can't.
It may cost them more money.
Right.
Even if they're buying a cheaper house, it may cost them more money. So it's like, well, why bother moving? So there's a lack of inventory just because so many people are trapped. And that may take a number of years. There's also a record high amount of equity. Some of it is inflation based as well. But, that price run up over the last few years, it's come down a bit in some of the top markets where it was really just at a, maybe just a euphoric peak in parts of 2021. But, some of them have maybe come down 5-10%. But overall, the housing market is still strong. I know a number of funds that have portfolios of foreclosures, and the foreclosures are still selling within 30 days. They're still often multiple offers.
Right. Inventory is not staying on the market.
Exactly. So residential is stable, and there's always little pockets of opportunity, but I don't see a crash. Now, for those that are on the sidelines that are waiting for
Perfect time to buy.
There are niches in the market where there's blood in the streets right now. And that niche is the multifamily real estate space where people have bridge loan debt.
Yeah. It's interesting as I go back, and I'm relatively new to the space. 2 years we've been putting in a lot of the homework, and it seems as though as I try to unravel this machine and how did they get there and learn these lessons so that I don't have to relearn them with my team, it seems as though they were so aggressive with acquisitions that they lost sight of operations, right? They were so competitive in getting that deal. They were doing things that didn't make sense. And that's something that my team, we keep going back and looking at. We underwrote 535 deals last year that we tracked, and we didn't even put the system in place until March. So God knows what that number is, but it's actually above 535. In those last 12 months, it's been really easy to get hard on ourselves. Like, why have we not found the right deal? And the only thing I keep going back to, there's definitely areas that we need to improve our processes and our procedures, but staying true to the fact that we're not losing sight of how we're analyzing the deals. We're not getting overly aggressive just to get the deal and then regret it tomorrow, right? And I don't know, I'd like to hear your take on that. If you think that's a reasonable hypothesis, or...
Yeah, well, a couple of things. Certainly, don't beat yourself up for not buying a deal in 2022. You probably saved yourself and your investors a lot of money by being selective and not overpaying. And I think you're right. There's definitely was a period of, I guess, with the term irrational exuberance where people were just being too aggressive. We were in a 10, 12-year upcycle. I think some of the people hadn't lived through 2008 and didn't have the scars. And I lived through 2008, and we have a different model. We're not underwriting 500 deals because we, are a capital provider. We're co-investing into deals, as either a co-general partner or through a fund-to-funds model where we negotiate special terms for ourselves and our investors just because we're actively investing in many deals and generally writing bigger checks than, say, the average accredited investor who's just going to maybe put $50,000 into a deal. Right. We're putting $500,000 or $1 million into a deal, and we're doing it regularly. So
can you go into details? Can you go into detail on that fund of funds model on exactly how? I think people want to know fund of funds. It's a great buzzword right now, but it's actually powerful. But most don't understand exactly why it's powerful and why you're able to get better economics for yourself and for your investors in that fund of funds model versus a traditional syndication model.
Sure. So it's very, and first things first, fund of funds sometimes gets a bad rep, or people think of it in the Wall Street terms where it's really an access play to get into some of these hedge funds that just would only take very large checks. So, what I look at is we're in a business that, we're providing access to alternative investment opportunities that most of the general public just doesn't know about. And the laws changed in 2012. Before 2012, these would be country club deals. You kind of had to know somebody.
Good old boy.
Yeah, you weren't allowed to advertise. And historically, these deals have outperformed the stock market. That 8-9% annual return. These syndication deals, that we've tracked that I've been involved in personally over 20 years, you can make that mid upper teens return. Not always, and nothing's guaranteed, but it's a niche, and because of that, you need to pay higher returns. When you're a publicly traded company and you spent millions of dollars going public, you can afford to pay a lower dividend. I think the average dividend in the S&P 500 is 3%. So I think first thing I want to say is these are, you have to be obviously careful and vet, but it's not too good to be true that you could see these 10, 15, 20% returns consistently. Anyone who runs a businesses can run at a 20, 30% operating margin. And this is closer to investing in a business. It really is investing in a business.
It is
not just real estate. So what we do, and when I had my exit, I knew that what I didn't want to do is have to look at 500 deals to find one, because it could cost you hundreds of thousands of dollars in pursuit costs to do that. And having been, in private equity in New York for years, I had all the money. We just needed to do the deals. So I've kind of gone through that. And I had investors that wanted to invest with me for years, but we weren't allowed to take small investor money. We had pension funds and institutions. So, when I was looking for a business, and as I said earlier, when I was in my 20s, I was helping people get into, house hacking, buy a two-family. And then I helped a lot of people after the 2008 crisis get into buying non-performing mortgages, because that's where the trade was at the time.
Okay.
And going forward now, a lot of my friends, colleagues, we're in our 30s, 40s, 50s, are starting to think towards retirement and have some assets built up. And so now I'm trying to help provide that access into these better opportunities in the stock market. There's a stat that, family offices, net worths of 50 million plus, often half or more of their money is in private equity, alternatives, real estate. But the average accredited investor that's worth 1 to 10 million has 80% or more of their money in the stock market, 90% in the stock market. So, part of my mission is to just educate and get people more access. And so I've personally invested in close to 50 deals at this point, both on my own and, my own money is invested in our fund. So we have a number of partners in different markets, and each of them is looking at those 500 deals, and maybe they get one, maybe they get two a year. And so we're getting sent 2 deals a year by 15 to 20 groups that we already know, we've already invested with, we've already had success with. And of those, maybe we do a third of those deals. So we may do 12 deals out of the 50 that we get sent, and they're looking at a combined 5,000 deals.
Right.
And because we show up and we've got relationships, it's not easy to raise money. There's a lot of operational friction. Right. There's paperwork to do, there's phone calls, there's emails, there's webinars, there's state filing fees. So the fact that we can write one check and they can call us and know that we may have 10 investors behind the scenes that we're pulling together.
You're solving problems.
Yeah, exactly.
Yeah.
We're saving them money. We're saving them maybe a salary for an investor relations person.
Right.
So because of that, they're willing to give us special deal terms. Now, in some cases, it just means they cut their fees. A typical syndication, maybe after everyone gets their money back, they're taking 30% of the profits, like a 70-30 split. We may negotiate to get an 80%, 20%. So they're only taking 20% instead. And so we essentially make our living off of that spread.
Okay.
So that we're not charging double fees. Because when you say fund of funds, the first thing that especially people I know from New York think is, we're double feeing.
Right.
And in general, our goal is to offset our fees by negotiating such better deal terms that there's enough for us to get paid. And, from our investors' perspective, they have our experience of vetting, seeing these hundreds of thousands of deals, having my personal experience, having made money. And, look, we're not foolproof. I've not made money on every single deal I've done in my life, but I've learned from every one of those mistakes as well. And all my investors will benefit from that as well.
Yeah, that's so valuable too. I think that's often, I'm really glad you hit that. I think that's often undervalued, right? Something you said there where like, hey, we have experience in betting these deals. When you look at something on the stock market and people are talking about it and they go to Robinhood and they buy 10,000 shares of whatever it is, they have no idea how that stock operates, what's going to make it tick, what's going to make it grow. They're doing it based off purely on emotion, right? But that's not what you and I do, right? We understand these machines because they are businesses, and we can go and we can analyze them and actually project what we anticipate future performance to be. And that's to me is incredibly powerful, right? That's not something that even most of your financial advisors are offering, that sort of a detailed analysis on what they're recommending. I think something else that's interesting is I had somebody tell me, when you're talking to your financial advisor and they're providing, we don't really use a financial advisor. We underwrite and evaluate our own deals. But that question, when they make the recommendation, do you invest in what you're recommending I do, right? If you're telling me to invest in Coca-Cola, do you have your own money there? That is something that is incredibly powerful in most of our niche, is that we do invest in our own deals. We put our money where our mouth is. And that's not the case in the general population.
Oh, absolutely. Yeah. I'm not every financial advisor is awful, but
sure,
there's a lot of awful ones. There's a lot that are really glorified salespeople, not really advisors.
Right.
And there's just so many levels of fees and just
hidden
structure.
fees.
Exactly. And conflicts of interest too. I was having a conversation with someone about infinite banking and, the whole life insurance. And a lot of those policies are providing a crappy return, in my opinion. It's like you're signing up for this 5% or 6% return, but there's other certain policies, if structured right, where you could actually borrow back 95% of your money, so that if you're an investor in real estate, you could have a long-term policy, but also you're really not paying much premium because you could borrow most of it back. And the reason a lot of them don't get sold is because there's less commission. So there's select advisors that work with certain entrepreneurs that actually, they're just taking the volume approach. They'd rather really work with a high net worth entrepreneur and structure something that works for them. And maybe they refer their friends rather than just selling the highest commission that maybe a salesperson that just works at a traditional wealth management or advisory firm is going to do. So there's a lot of corruption there. And often they're rarely investing their own money in their own deals. Right. And the one other thing, it's a pet peeve of mine. I don't know how many conversations I've had where we've talked about one of our opportunities or our funds, and they say, okay, well, I'm going to talk to my financial advisor.
Right.
I tell them, I know what they're going to say. Number one is they're not allowed to recommend something else because it's called selling away.
Right.
It's actually like a violation of their rules. But otherwise, any money that comes out of their account to invest in a real estate or a syndication or a private deal, it actually is lowering their fee income. They make money on assets under management. And if you're withdrawing money, it costs them money. So they have an inherent conflict of interest, and they're rarely, if ever, going to recommend a real estate opportunity, a syndication. Just it doesn't make financial sense to them.
No, it's like going to Toyota, looking at a Tacoma and saying you're going to go over to Lexus and ask them their opinion of it. Like, what do you like? Of course, it doesn't make sense. Most people don't see it for what it really is. They don't understand that machine. Yeah. So 2008 was pivotal. It was definitely a phenomenal lesson to be learned for myself. I knew nothing about market cycles. I'd just gotten to a point where my wife and she thought I was crazy, but I knew we needed to buy a house. I knew real estate was the way. I didn't completely understand why, but I looked around the room and I saw the proverbial room. Like, real estate was where the majority, I think it's 90%, right? 90% of Americans have made their millions, right? So I had to get out of apartment into a house as soon as possible. But then overnight, I mean, we saw it happen, right? Like, almost all of America lost half their value. 2010 hit, and our neighborhood was all on sale. I knew the right answer was to go buy again, but I just couldn't convince myself to pull that trigger again because I had those scars of what happened to me just a couple of years ago.
Yeah, that's not uncommon at all. I think when the market's in this bull run, there's this euphoria and people overpay. They don't do their diligence. It's the FOMO, and
right.
They dive right in. But that's the most dangerous time to be buying. And then by the time the market's already crashed, there's this residual fear that often lasts for a few years. And sometimes you miss the boat, you miss the bottom. And that's what happened. Those that bought in 2010, 2011, 2012.
While everybody was afraid.
Yeah. And so, again, I know people waiting for that on the residential side. I don't see it happening on the residential side for various reasons that we mentioned before, but it is happening now on the commercial side. So I caution those that are kind of waiting and trying to time the market perfectly that this is the time, and it's not the same type of crash. This is much more of a crash related to financial engineering, the variable rate loans that have 5x the interest rate,
right?
Increased insurance costs. There's a lot of pain in that commercial space right now, and the new capital that comes in, this is 2010.
Right. This is exactly
like buying those deals at 30% less than they were a year or 2 years ago. Mm-hmm. And I really am encouraging my friends, my family, my investors to take a serious look at diving into commercial real estate at the moment, because this is the opportunity. If a deal works today after this unprecedented move in rates, and if a deal is profitable with a 6.5%, a 7%, and 8% current interest rate, and a higher cap rate, and we could talk about cap rates in a second, but if a deal works now, it's probably the safest time to invest. And I also caution people that did jump in 2 years ago and maybe are in a deal that has some struggles or is not producing the cash flow they hoped. You need to keep investing. You can't let that one opportunity sour you on the new opportunities. It's about dollar cost averaging and being active in the market. And I hate to, this is more of a traditional financial advisor quote. It's about time in market, not timing the market.
Right.
And in real estate, that does apply. And, I'll quote a quick stat from, I think my value investing class in business school. We did a case study on, if you put all your money in the stock market the day before the 1929 crash, it would take you 12 years to break even. Mm-hmm. However, if you put it in over a 12-month period, 6 months before and 6 months after in 12 equal installments, within 2 years, you'd be break even.
No kidding. Yeah.
And that's the same in real estate. If you were in from 2006 to 2011, you probably lost your shirt on a few deals. But if you kept investing in, then you caught that upswing and bought some stuff really cheap at the bottom. And, net, you're probably a multimillionaire.
Absolutely. There's so many great things to unpack right there. I mean, just with my own home, we lost 50% of the value overnight, right? That was a tough pill to swallow, but real estate appreciates. We're not making any more land, right? The demand continues to go up. And even though I lost 50% then, I'm up over 200%. And I haven't owned that house I think we're about 12 years now. If I would have bought multiple houses along the way, if I would have bought in 2010 when everybody was afraid to get in, that same house, I'd be up 400%. It's nuts. Warren Buffett, the analogy that you just gave about timing the market, if you would have 12 equal installments across that time, he talks about us buying the smile, right? Because even the king of investing, Warren Buffett himself, says, I can't time the market, right? So he likes to buy when it's coming down. He doesn't have any idea when it's actually at the bottom, and he buys when it's coming back up again. But he never buys at the top.
It just made me think of something else about, we're not really trying to time the market either because we're consistently investing. I just think now is a safer time, but we're looking for deals where we do not need to rely on macroeconomics or appreciation to make the deal work. A majority of our deals have some type of value add. On multifamily apartments, it's renovated apartments. Take rents from maybe $1,000 to $1,200 because you have a newly renovated apartment.
Right.
There's a lot of demand for affordable workforce housing that's a higher quality. So a building built in the 70s or 80s that has the original cabinets, somebody will rent that for $800 or $1,000, but you put in a new kitchen, new bathroom, new flooring, and you have an option at say $1,200 or $1,300. There's a lot of demand for that because the newer to buy a house, it's unaffordable.
Right.
And people are priced out of buying new homes because of the interest rates and the lack of supply. So there's a real demand for kind of middle-class workforce housing that's of a high quality. And if you force that appreciation, when you raise the rents by a few $100s a month, say $400 a month, call it $5,000 a year in increase in rent, that $5,000 increase in income will raise the value of your building by over $100,000 in many cases, depending on what the cap rate is. Yeah, we were talking about supply.
Right.
And I could talk a little bit more about that. So I actually took a bus tour around Phoenix looking at a number of properties that some colleagues are already invested in. And they're focused 100% on the Phoenix market. Mm-hmm. And Phoenix, like I said before, nationwide, very supply constrained. A lot of people from California moved here, paid cash.
Yeah, they see it as cheap real estate.
Yeah, so there's very, very little supply of housing. There is, however, a lot of new apartment buildings that have come up in recent years.
Right.
It's the one area, single-family housing starts have not caught up, but there was a demand for apartments, and especially in these boom markets, a lot of apartments did get started a few years ago, right before interest rates went up and right before the supply chain and the construction materials. What's happening now, though, is there's really not as many new ones are being permitted now. So you have all this supply coming over the next 1 or 2 years, and then maybe nothing for the next 5.
Right.
But in our class, what we talked about, that the multifamily, the value add, the class B, the workforce housing, none of this new construction is workforce housing.
Right.
You cannot afford to build affordable housing unless there's like some type of free government money. So what's being built is $2,200, $2,500 a month rent apartments.
Top of the market.
Yeah, and we're in the $1,000, $1,300, $1,400, $1,500 price point market. So I don't see this new supply really affecting the markets that we invest in that much. Now, sure, there's maybe a few tenants that were on the cusp that were in the $1,500 market and say, hey, this one would be $2,200. Maybe the first year they discount it to $2,000. Maybe there's a little pressure here and there, but I don't think it really changes the math that much. Maybe we underwrite a little more conservatively.
As far as occupancy, vacancy, stuff of that nature, absolutely. But that is quite the jump. The other thing that's very interesting to me is that recent stat came out that the average American needs to make at least $150,000 a year based off of today's interest rates to be able to afford a new home. And the average salary in America is $75,000. They're literally halfway there, right? So they just can't afford to go buy a new home right now.
We have a generation that's going to rent longer.
They just can't afford it.
They can't afford it, yeah. And that's going to take some time, and I don't see it going away anytime soon. The era of affordable housing is maybe gone. The goalposts are being moved on what is affordable, and just more people are going to be forced to rent. And it's a shame because real estate is how a lot of people have built their wealth. My parents bought a house for $36,000 in the 70s, and
wow.
Time they sold it, it was worth a few hundred. It was a decent part of their their nest egg. And, then there's some people in California who got super lucky and,
Right.
paid 80 grand and sold for $4 million. And, but yeah, it's a challenge, and, it's unfortunate, but I think, it's also cultural as well. People are there's a lot more people who move jobs more often. This is not the era of you buy a house, you're living it for 30 years, you keep the same job.
The American dream isn't what it used to be.
Yeah, so while, the affordability is the issue, I think the lack of desire is also there. And I think there's a greater percentage of the population that is moving more often for jobs, doesn't want to get tied down with a house as early. People don't get married until much later, like close to 30 or early 30s in many places, as opposed to 30 years ago, people were getting married at 22 and buying a house. So yeah, it's a cultural shift. This economics thing, it's not just going to end overnight. It's going to take a period of time to work itself out. And I just think overall, people are going to need to save longer and rent longer before they buy, and perhaps maybe less people buy in general. Because even on the single family market, there's a number of private equity funds that have build to rent portfolios. They build them new construction, and they expect to rent a majority of them rather than sell them.
Mm-hmm.
There's large demand for that, both from renters that even want a house instead of an apartment, and the hedge funds love that market. It's newer construction, and they have optionality. A number of them also own mortgage companies, so maybe in 5 or 10 years they start converting some of those rentals into properties to sell. Taking advantage of appreciation, taking advantage of inflation, and we've had a lot of discussions here. Bob Frazier from Aspen gave a great talk yesterday about inflation, and he thinks inflation is here to stay. A couple key reasons. Number one is the baby boomers are all retiring. It was the largest generation. There are not enough workers.
Right.
Yeah, I know.
Nobody wants to work. Everybody's talking about it across America. Nobody wants to work anymore.
Yeah, and I know a lot of people own businesses. It's hard to find good talent, and you have to pay up. And one of the biggest contributors to inflation is wages. Mm-hmm. And with a shortage of workers, people are demanding higher incomes. It's all this babble about the minimum wage. I think the market economy is taking care of it on its own.
Yeah.
In-N-Out Burger was advertising $20 an hour in Southern California.
Oh, Southern California.
Yeah. So
California's different.
Yeah.
Yeah.
So, but I like the free market economy, and I think in most cases, people are paying more than minimum wage anyway now.
Right.
In many places, because there is that demand.
Yeah. Inflation's always talked about as a negative thing, but it doesn't have to be negative. It really doesn't have to be negative to your lifestyle, your portfolio, if you manage inflation instead of letting it manage you, right? And so we hear this term in real estate as a hedge against inflation, but connecting those dots for a lot of folks, I don't think they really see it. So I'd love to hear your take on how exactly inflation is a hedge. How real estate is a hedge against inflation.
Sure. I mean, so again, it's a supply constrained asset. So over time, it's going to go up in value, but having the ability to have debt. Now, I'm not saying over leverage or take out too much debt.
Right.
But if you're borrowing and you are borrowing at 6%, I think real inflation is above 6%. They're saying it's 2% annual, mm-hmm. But when you factor in, if you look at shadow stats on the way they used to track inflation, it's much higher. But you're borrowing in today's dollars. 20 years from now, you're paying back those dollars, even if you're using the real numbers. Those dollars are worth 2% less every year.
Right. And
you're paying back, when you're on year 10 of your 30-year mortgage, you're paying back at that dollar you're paying back is worth a lot less than the dollar that you took out before. So that is a good hedge against inflation. Gold, silver, precious metals, potentially cryptocurrency, I think are all potential hedges against inflation. And, owning a business that's spitting off positive cash flow is also, obviously a great way to have the optionality to because the business could generally raise its prices quickly. Of all the assets, multifamily is also the most nimble for that because rents get reset once a year. Mm-hmm. Generally you're on a 12-month lease versus office, commercial. Sometimes you have
5-10 year contract.
10 year, yeah. So of all of them, I think multifamily is also the best hedge against inflation. And although we talk a lot about the bridge debt, that's a minority of the market, but that's where there's a lot of golden opportunities for those in pain right now. But there's still a great majority of multifamily apartments went in with 10-year fixed rate debt. And those people are doing fine. The right. Family offices, the institutions, the long-term holders, that's a great hedge against inflation. Most of them locked at 3% and have 7 years left.
And they didn't worry about a storm because they knew with a 10-year hold, they were going to be able to weather any storm that comes. Real estate's typically a 12-year cycle. So I love looking at inflation when I explain it in the terms of gas. We always talk about gas prices. Look at that. The gas just went up. sure back when you were a kid, gas was probably about $1 a gallon or less, right?
In New Jersey, it was less than $1.
Right.
And we didn't have to pump it.
You didn't have to pump it. Somebody pumped it for you. It was less than $1 a gallon. And so if I would have had invested in let's just take a single gallon of gas and done that, my money would have grown up to, what is it now, $4 to $6, depending on where you're at in America, possibly higher. I think it was $8, $9 in San Diego when we actually moved out of there. But if I would have left that same dollar sitting in a bank account, I wouldn't have been able to buy that gas today, right? And so that visualization, I think, is a very clean way to show people how real estate is a hedge against inflation. As my money's put into something that is going to be affected by inflation, its value is going to numerically go up over time, regardless of inflation, up or down, right?
You know, it just triggered, reminded me of just the whole process of compounding.
Right.
And, you know, when I push people to look at these alternatives, the difference between having a portion of your money earning 15%
right.
IRR or roughly annualized return and compounding that over 5 or 10 years compared to 8% is it's life-changing. It's the difference between retiring or not.
Right.
And that's why I push people to look heavily. And yeah, you can use that financial calculator. There's tons of them. You can say, well, what happens if I earn 8% annual for 20 years, or if I put in an extra, even if it's an extra, I mean, we work with a lot of higher net worth people, you know, taking 50 to 100,000 a year, instead of putting it in the stock market, move it into alternatives, and have 20, 30% of your portfolio in alternatives instead of just in stocks and bonds. If just that portion of your portfolio, you know, outperforms and does that, you know, 12, 13, 15% instead of 8, that could be an extra $1 million, $2 million in your bank account for retirement.
So Bright Peak Capital, we talk a lot about reaching our summit, and it really came from getting to the end of my 20-year naval career, where I spent about 8 years cumulative with my wife, 12 years away. And I realized as I was looking for my next job following the military, and there's a lot of opportunity to get into government jobs, you know, that are pretty similar to what you were doing while you're in. I realized that it didn't really matter how much money they offered me. It wasn't going to solve my problem, right? It wasn't going to help me make up for lost time, and truly you can't make up for lost time, but it wasn't going to help me spend the time with my wife and grow with her and really just go live the life that we didn't get to live during that previous 20 years. So I turned those jobs down. We went into business together, and to me, that was my summit. Being able to live and breathe and get to know my wife better, like really get to know her better, go on travel together, build a business together. For me, that's my summit, right? It's not a dollar figure. It's not a big yacht. It's not a Ferrari, although a Ferrari would be nice. Who doesn't want a Ferrari? So my summit is really just living my life the way I choose to do it, not the way somebody else tells me to go do it. So I'd love to hear, you know, you've been in this game for a long time. You've seen that money doesn't buy you happiness. It does buy you things that can result in bursts of happiness, but what does your summit look like?
Yeah, I think we're pretty similar with that. And I had a mentor early on tell me, he's like, you don't want money, you want freedom.
Right.
Now, you need enough money to have that freedom. But yeah, at this point, after being trapped in New York and making more money than I ever thought, but not having control of my time and my freedom, and it caused stress. It caused, I couldn't open my mouth all the way. I had like a TMJ, which normally you get TMJ from braces, but just the stress, I would yawn and my jaw would like snap. Yeah, just if I opened my mouth all the way. So it was causing health issues. I'm sure I had, I didn't get my blood pressure checked at the time, but I'm sure the stress wasn't good. So, I was able to fortunately, work through it and made those life changes. But yeah, now it's like, I just want to build a sustainable business that, I use the term lifestyle business. It doesn't mean I don't want to work. I love to work, but I like to work on my own terms. This is work. We're at a conference, hanging out, sharing ideas, exchanging deals, talking about future opportunities. This is fun for me. It doesn't feel like work. So when I set up this company, it's like, what do I like to do? I love to advise investors. I'm not a formal financial advisor, but I love nothing more than strategizing. I took a step to move to Puerto Rico for some tax efficiencies for myself. And I found that a lot of my counterparts, like, there's no one place to go to figure out how do you structure, how do you get into these alternative investments? How do you structure your taxes right? Can I roll over my 401k from a job that I got laid off on and use it to invest and get higher returns? So I really like to be, and I don't do this formally by any means, but I look at it like a mini mastermind that I'm trying to provide this information and value to my friends, my potential clients, my potential investors to help them. And then on the other side of the coin, I know I'm not an operator myself. I don't want to be chasing 500 deals, but there's a lot of people that are really, really good operators that either don't have the bandwidth or just really aren't salespeople. They don't like to go out and schmooze and shake hands. They just want to be, they're introverted, but they're really good at what they do. So helping those people who are great partners for me, accomplish and execute their goals of buying real estate and providing these returns. It's a perfect partnership. I've always been a connector. So, if I can basically spend most of my time connecting, and
there's a lot of power in that.
Yeah, and have the ability to do it from anywhere. I spent 2 weeks in Buenos Aires in September.
Nice.
I worked. I had Zoom calls. Most people didn't know I was even down there, and it was amazing. Spent some time in Europe. I did business school in Asia, so I spent. I try to get to Hong Kong once or twice a year. I'm still hoping to get some more investors from over there. I haven't quite cracked that code yet. So if you're listening to this from Hong Kong or Singapore and you want to invest in U.S. real estate, please hit me up. And so I kind of went long-winded there, but it's about helping people, connecting, and just generally doing things I enjoy.
So if I were to boil that all down, it's not Ferraris, it's not big houses. It's genuinely helping people get what they want, helping them solve problems, connecting people. Really, it's people.
Exactly. Again, Ferrari would be nice. If you follow me, I do love to fly first class. I use points and miles for it.
Yep.
Rarely am I paying. You see me in like international first class, like laying down in bed. Yeah, I'm using miles for that. I'm not spending 10 grand for it, but it's fun. I enjoy the arbitrage of finding ways to get things for a good price, whether it's real estate, whether it's flying. I enjoy the hustle with that. It's fun, and it's also a hobby I love. Teaching people about too.
That's awesome, man. Well, thank you for sharing that. I really appreciate it. It's been a pleasure talking with you today. I'm so glad we got a chance to meet.
Absolutely. What an amazing conversation. We should do it again sometime.
Absolutely.
Awesome. Thank you.
Thank you.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.